everyone. I am Dr. S. Siva Sankara Rao, working as an associate professor in Institute of Aeronautical Engineering College. And um, today I am going to give a video lecture on cost concepts. So, cost concepts is one of the concept of business economics and financial analysis module. And in this cost concept, before going to explain the cost concepts, first of all, we need to know what is the meaning of cost. So, in general, everybody use cost instead of the word cost instead of selling price. In general, when we go to any shop or any place, we generally used to hear the word that is what is the cost of this particular product. Generally everybody use this word, but you should not use the verb cost, but because it is different from selling price. So the selling price is consists of cost plus expected profit. So the cost means it is the amount of expenditure which is incurred to attain a particular product or service. To manufacture a product or to provide a service, we need to incur a number of aspects or number of things we have to made. So for that we have to incur some amount of cost. For manufacture of product, you need to employ number of labor. They need to be paid with wages, and you have to pay the some amount for the purchase of raw material, and you have to pay some amount for the purchase of machinery and for maintenance of machinery and assets. For all these things you need to incur different amounts of cost. So these particular expenses altogether called as cost. So here in the business economics and financial analysis, the costs are differentiated into various types. First one, business cost versus full cost. Business cost means here the business cost is the total amount of expenditure incurred for carrying out all the business activities. So to run a business, you need to perform different kinds of activities. Like you have to purchase the raw material and you have to process it and you have to pack it and you have to deliver it to the shops, and you have to maintain a distribution channel. Like the product is to be reached to the customers, you have to forward the product to the distributors or dealers and wholesalers, from there to retailers, and from there to customers. This is the channel in general we follow. So for all these things we have to maintain some amount of expenditure. Distributors and wholesalers, all these persons have to be given with some amount of margin, and to transport from manufacturer to distributor you need to incur some amount of transportation cost, and uh, for packing, advertising, and like this n number of things, n number of expenses are there. And if you want to conduct a survey to know the customer views about your products, you need to conduct a kind of R&D activities. You have to you have to conduct a research activity. With a questionnaire you have to approach different number of customers, and you have to collect the opinions of customers, and they will give you some information, and you have to analyze that, and then you have to interpret the conclusions from that field questionnaires. For doing all these activities you have to run an R&D department. So, and you have to maintain some equipment. For example, if you want to design a new product, you need to have some technical equipment, and like this R&D department is going to perform its own activities. So to run all these departments, or to perform n number of activities, you need to incur huge amount of expenditure. All these expenses together considered as business cost. And second one is full cost. So the full cost is the all the expenses to incur all the expenses incurred to run a business, and uh, this particular amount is to be added with opportunity cost and normal profit. So first of all, what is meant by opportunity cost? So to obtain the full cost, you need to add opportunity cost and normal profit to the business cost. So business cost is the amount of expenses incurred to run a business activity. And opportunity cost means, opportunity cost is the sacrificed profit from the last best opportunity. For example, if you have some amount of money, for example, assume that you have 1 lakh rupees of money, and for this you have this amount is to be invested in three different alternatives named 1, 2, 3. So the first alternative is going to give you 30% of return, and second alternative is going to give 25% of return, and third alternative is going to give 20% of return. So generally we select first opportunity, that is 30% of return. So we are going to invest our money into this first option, and by investing this money into the first option, you are going to lose this 25% of income which is about to generated from the second best opportunity. This 25% is called as opportunity cost. So here generally everybody is having about the having the doubt regarding it is not obtained profit. This is the profit about to obtain if you have the investment, if you have chosen the investment alternative, and why you are considering this as the cost. This is the general doubt. And here the explanation for that is, here while running the business you are not having assurance or any confirmation with respect to the expected amount of profit. Means, for example, here you have selected the first best opportunity that is about to yield 30% of return, and there is no guarantee that your selected opportunity is going to give the same amount of return. It may yield more than that expected percentage, it may yield less than that expected percentage. So here there is no guarantee. In this situation, if you want to change your alternative, you are going to consider this opportunity cost. For example, because of the uncertain future, you may not get the same amount of expected profit in future. So in the initial year you may get 30% as expected, and in the second year you may get 28% of return, and in third year you may get 25% of return, and in fourth year you may get 23% of return. Like this, the return may increase or decrease. So here every year you are about to compare your actual return with the expected return and opportunity cost. So here in the first year your expected return is 30% and your actual return is also 30% and your opportunity cost is 25%. So here you have to compare this opportunity cost with the actual return. So opportunity cost is 25%, your actual return is 30%. As the actual return is more than the opportunity cost, you are about to continue the same decision. Means the decision, the investment alternative you have taken is more worthier than the second best alternative, that is opportunity cost. And in second year you have get only 28% of return, and in the second year also you are about to compare this 28% of return with the 25% of return opportunity cost. So 28% of actual return is more than the 25%. Then you continue the means you have your selected decision is going to give best return than the opportunity cost. And when come to the third year, your actual return is reduced to 25% and your opportunity cost is 25%. So here you have the dilemma whether to continue this investment alternative or you have to you want to withdraw your funds from the selected alternative and invest in the another alternative. So you have the dilemma. And while coming to the fourth year, your actual return is 23%, but the opportunity cost is 25%. Here you have the idea, you may get the idea that actual return is 20%, and if you might have selected the opportunity cost, that is second investment alternative, you might get 25% of return. So here your actual return is 23%, which is less than the opportunity cost 25%. So in this situation, you are going to withdraw your funds from the first best alternative and invest in second best alternative. This is called disinvestment from the first alternative and investing in the second best alternative. So for this kind of comparative decision making, you are going to select, you are going to choose this opportunity cost. And every year you are about to compare your existing profit percentage with the opportunity cost percentage. As a result, you are about to take the investment and disinvestment decisions. Okay, so this is the opportunity cost, and this particular amount of opportunity cost is to be added to the business cost, and then you will get full cost. And along with these opportunity cost, you have to add the normal profit also. So see here, normal profits. So normal profits means this is the normal profit percentage which you are about to get. For example, if you have 1 lakh rupees of investment money, and you may have different number of alternatives. For example, you may invest in business and you will get some amount of money, for example 30%, and you may invest in another fixed deposits, you will get some 15% of return, or you may give it to the interest for some other outsiders, you will get some other 18% of return, means 1.5 rupees interest rate. So here like this you have number of alternatives. Here in this situation, in the second and third situations, you are not going to take any sort of physical activity, you are not working hard, so you are just lending money to the others, you are not working, and you are not going to work anymore, and you will get some amount of return, that is fixed deposits you will get 15%, and let the outsiders to uh, for interest, that is 18%. And so these are the two situations, you are not doing any kind of business activity and you are going to get some amount of return. And by doing business you are going to get some amount of money, you are going to get some amount of money means you are going to get some amount of profit. So here if you are about to get 15% of profit, then it is not considered as normal profit, then it is not considered as a profit. So here for this kind of decision making, the business persons or entrepreneurs are going to set a profit percentage, that is the normal profit percentage. So this is normally 24% of profit. So means up to 2 rupees interest. In general, outsiders are going to lend their money for 2 rupees interest without doing any kind of work or any kind of uh, work or anything. So they are going to get 2 rupees of interest as income for the invested money. By doing business, you are about to get more than this particular percentage of profit. That is called as abnormal profits. Abnormal profits. So here, this is the thing you have to consider. So means by investing 1 lakh rupees of money, you are doing some business and you have get 24,000 rupees of income on this money, and this is not at all considered as a profit. If you have earned more than this 24,000 rupees of money, then only it is considered as profit. So because without doing any activity, you can get the interest amount of 2 rupees or 24% of interest on the this particular investment amount. So that's why this particular 24 percentage is considered as normal profits. And if you are about to uh, earn this up to this particular percentage of profit, it is not considered as the profit. More than this percentage only, it is considered as profit. So that's why while considering the full cost, the total cost of business means business cost, total business cost, and opportunity cost and normal profits together considered as the full cost. And next one, total cost versus average cost versus marginal cost. Next, total cost, average cost. Okay. Next concept, total cost, average cost, marginal cost. So the total cost is the amount of total expenditure which was incurred in business. It is equal to the business cost. So to carry out the normal business activities, you have to incur some amount of money, that is called as total cost. And average cost. So here, by incurring some amount of money, you are going to get some quantity of output. When you are going to divide the total cost is going to be divided with number of units, you will get average cost. Means on our average cost to manufacture a particular product. And the formula for average cost is total cost divided by quantity. Total cost divided by quantity. And next one, marginal cost. Marginal cost means this is the amount of additional cost incurred for additional unit of manufacture. Here, for example, if you have manufactured 100 number of products, you have incurred some amount of cost. And for manufacture of 101 unit of product, you are about to incur some more amount of money. That difference of amount is called as marginal cost. This is the formula for marginal cost is Tn minus Tn minus 1. So the total cost for manufacture of n number of products minus total cost manufactured for n minus 1 number of products. So this difference is called as marginal cost. In this way, total, average and marginal costs are going to be classified. This is one of the classification. And third classification is private cost versus social cost. Here, the private costs are the costs which are actually incurred by the organization. So this is called private costs. Means the costs which are incurred by the organization is called as private costs. And the organization for some of the things need not to be incurred. Those are called as social costs. Means some of the things are going to be used from the environment itself. Those are called as social costs. Here, for example, take the example of hydel power companies. The companies which are going to provide hydel power. And to generate the power through hydel, they need water resources. So generally, where the rivers are going to be existed, the canals of rivers are going to be existed, there the hydel power plants are going to be established. So here for this, they are going to establish, they are going to place the turbines while the flow of canal, and when the water is going to be flowed through canal, the power is going to be, turbines are going to be turned, and the power is going to be generated. So in this way, they are going to generate the power. For the flow of this water, they need not to incur some any amount of expenditure. In case of absence of this, they have to use artificial motion power to run the turbines. So for that creation of artificial motion, they need to incur some amount of expenditure. So these are called as social costs. Here, because of the existence of the natural movement of water flow, you need not to create artificial motion. So in such a way, uh, you need not to incur some amount of cost. So that is called as social cost. Here, in in case of the absence of these natural resources, you need to incur some other additional amount of expenditure. So here, because of existence of natural resources, you need not to incur for these natural resources. Any sort of additional amount is need not to be incurred for these natural resources. So if you add these particular amount to the business cost, you will get the social cost. Means the cost of business cost plus the cost incurred for acquisition of natural resources. That is called total cost. Okay, so the social cost is equal to business cost plus the cost which are need not to be incurred for existence of natural resources. This is called as social cost. And next one, long run cost and short run cost. Next category is long run cost and short run cost. Long run costs are those costs which are going to be incurred in the long term future or long time period, and short run costs are those costs which are going to be incurred in short run time period or nearby future. So here, what time period is considered as long run and what time period is considered as short run? Here these two things you have to decide. So here, while we are going to get the explanation regarding the basic concepts of managerial economics, you will get a concept that is time perspective. So according to the time perspective concept, the time is divided into two. First one is long run and the second one is short run. So here, what is considered as long run and what is considered as short run is going to be decided and according to the discretion of the management. Means the management is going to decide some particular X is a time period. So if you have uh, a time period beyond that X time period, that is called as long run time period. If you have a time period which is less than that X period, that is called as short run time period. For example, in managerial economics, assume that to construct a building it takes 1 year, but you have to start the production within 6 months. Here, the existing time period with you is 6 months, and the uh, time period of X value is determined by the management is 1 year. Means here to construct a building, it takes 1 year time period. Here you have to consider this 1 year as X value. So, but you have the time period that is only 6 months in your hand. So this 6 months is less than the 1 year, then it is called as short run time period. And in second case, if you have 14 months to start your production, this is more than the X value. That is, to construct a building, it takes 1 year and the time for starting the production is 14 months. Means it is more than the 1 year. Then it is considered as long run time period. So in this way, short run and long run are going to be considered. And next one, fixed costs, variable costs and semi-variable costs. Fixed costs. Fixed costs are those costs which are going to be remain fixed at all the levels of production. Whether you have manufactured 0 units or you have manufactured infinite units, you have to incur same amount of cost. That is called as fixed cost. and some of the costs are there, they are going to increase or decrease along with the scale of production. Those are called as variable costs. For example, here take the example of raw material. Here, if you manufacture 1 unit, the standard quantity of raw material consumption is 10 grams. Assume like this. So if you manufacture 1 unit, you need 10 grams of raw material. If you manufacture another product, you need another 10 grams of product, then total 20 grams. In this way, the quantity of raw material or cost is going to be increased along with the scale of production. As much quantity of production you are going to manufacture, you have to incur that much amount of cost. That is called as variable cost. Unlike this raw material, some of the costs are remain fixed. For example, employees salaries in administration department, or in production department, or production manager, office staff, all these people are going to get the salaries irrespective of the production. Whether they manufacture 0 units or infinite units, they are going to get same amount of salary. But raw material is going to be increased along with the scale of production. So as a result, the cost incurred for the raw material is also increased along with the quantity of raw material. So in this way, the variable costs are going to vary with the scale of production, and fixed costs do not vary with the scale of production, and these are going to remain same. And next, coming to the semi-variable cost. So these costs are fixed up to some time period or some level, and after that these costs are going to suddenly rise, and after that these are going to fixed remain up to another level. For example, the surcharge levied in our electricity bill is the perfect example for semi-variable cost. For 0 to 50 units, you are going to get 35 rupees of surcharge. And from 51 units to 100 units, you will get 55 rupees of surcharge. And these costs are fixed up to some level, means 0 to 50. After 50, these are raised suddenly. And from 50 to 100, these are constant. And after that, suddenly they are going to raise. So like this, the semi-variable costs are going to vary, are going to move along with the units or scale of production. Units means units of manufacture. So like this, fixed costs, variable costs, and semi-variable costs are going to be existed or classified. And next one, controllable costs versus non-controllable costs. Controllable costs are those costs which can be controlled by us, and non-controllable costs are those costs which are uncontrollable. So you cannot control those costs, you have to bear them. For example, here you can insure your products. You can insure your products. In case of fire accident or any accident, you will get the insured amount. So in this way, you can recover the loss. For example, taking precautions to not to get thefted our products. That is our controllable activity. For example, taking proper precautions to not to get fire accidents or not to get thefted and pilferage. So like this, you can control some of the things. These are called as controllable costs. Means these costs can be controllable. And some of the costs which could not be controllable. For example, while you are transporting the petrol, there will be some amount of evaporation. A minimum amount of evaporation will be existed. And you cannot completely avoid this evaporation. Whatever the measures you have taken, even 0.5% of evaporation is also existed. So here, like this, the evaporation of petrol is uncontrollable, but you can minimize by taking some amount of precautions. Like this, some of the costs are controllable, those are called as controllable costs, and some of the costs are uncontrollable, these are called as not controllable costs. And next one, opportunity cost versus outlay cost. So in the first side heading itself, we have seen what is the opportunity cost. Opportunity cost is the income lost from the last best opportunity. That is the income lost from the last best opportunity. So here, in another words, you can say that this is the sacrificed profit by deserting the second best opportunity. So here I'm going to explain once again. You have some amount of money, that is 1 lakh, and you have 2 or 3 alternatives, and each and every alternative is going to give differentiated return. And by selecting the first best opportunity, you are going to lose the second income of second best opportunity. This second best opportunity's income is called as opportunity cost. This income of second best opportunity is called as opportunity cost. So this is to be considered for the purpose of decision making. So here, because of the uncertain future events, you are not guaranteed that expected income or profit is going to be generated or not. So in such a situations, you will get less amount of the opportunity cost. You will withdraw the funds from the first best opportunity, and you will reinvest the same amount in the second best opportunity. So to take such kind of investment decisions, you have to consider this opportunity cost. And next, outlay cost. Outlay costs are those costs which are having physical cash outflow and entry of books in the records. And some of the costs are uh, going to be recorded in books, and opportunity cost is not recorded in the books of accounts. This is considered, this is calculated and set aside in the documents for the purpose of decision making. In books of accounts, it is not showed as an expenditure, but the wage payments or salaries payments, electricity bill payments, raw material purchase, transportation charges, these kinds of expenses are all shown as an expenditure in the books of accounts. So these kind of costs are called as outlay costs, because these are physically paid and they are going to be recorded in books of accounts. And opportunity cost is not going to be recorded in books of accounts and recorded in managerial books, not books of accounts. Okay. And this is not physical payment of cost. And next one, incremental cost versus sunk cost. And this is one of the most important cost. Incremental cost. Incremental cost is the cost which is going to be increase your existing costs. That is called incremental cost. For example, you have started construction of a building. It takes 6 months to construct your house. And during the time of beginning of construction of building, a cement bag selling price is 500 rupees, and after 2 months the selling price of this bag is increased by 50 rupees, and now the selling price of cement bag is 550 rupees. This is the incremental cost. Here, in the same way, in organizations, you are going to take some kind of decisions which are about to increase your costs. For example, if you want to give increments to the employees, it is the incremental cost. And you want to purchase new machineries, this decision is about to increase your cost. So these are called as incremental costs, because the decisions which you are about to take is going to increase your cost, that is called as incremental cost. And next one is sunk costs. Sunk costs are those costs which are going to be increase your cost and which could not be recovered. For example, if you have purchased a new machinery, I'm going to give one example for both increment cost and sunk cost. That is, for example, if you have taken to a decision to purchase a new machinery which is worth of 1 lakh rupees, it is called as incremental cost. Because by taking the decision of purchase of new machinery, you have to incur 1 lakh rupees of amount that is going to increase your cost or expenditure. That is called incremental cost. And second situation, that is, if you want to replace the existing machinery, that is 1 lakh rupees of machinery presently you have purchased, and meanwhile you have an updated machinery that is worth of 1.5 lakhs, 1 lakh 50,000. So, and the profits generated from this existing first category of machinery is going to be some 100%, and by taking this decision you are about to take, you are about to get 200%, means the profits are going to be doubled by taking this decision. And you have taken the decision to replace, you have taken the decision to replace the existing machinery. So here you have already incurred 1 lakh rupees on this particular machinery, and you are about to incur 1 lakh 50,000 rupees on the next machinery. And this particular machinery is having a particular lifetime. For example, assume that this is having 5 years of lifetime, and you have used it for 2 years. And after 2 years, the value of this machinery is 60,000 rupees. Means the 60,000 rupees is about to recover from the usage of this machinery. So here, this 60,000 rupees of machinery is going to be set aside idle by replacing this particular machinery with 1.5 lakh rupees. So as this 60,000 rupees of machinery is going to be worth zero, this is called as sunk cost. This is the cost which is already incurred, and this particular 60,000 rupees of amount could not be recovered. You have incurred 1 lakh rupees of income on this machinery. You have incurred for 1 lakh rupees of amount on this machinery, and you have recovered 40,000 rupees of machinery by using 2 years. And now the machinery value is 60,000, and this 60,000 is going to be set aside. Means this machinery is going to be idle. This is not used. This is going to be idle. And this could not be, this amount of 60,000 could not be recovered. So that's why it is called as sunk cost. Okay. So in this way, incremental cost and sunk cost both are going to be differentiated. And next one, explicit cost versus implicit cost. Explicit cost means explicit costs are having two features, that are physical payment of cash and entry of record in books. Means some of the costs are there. Those costs are not having this kind of feature. So if any cost which is going to be physically paid and which is able to record in books of accounts, both the features are consisted by this particular cost, then it is called as explicit cost. For example, payment of salaries or wages, electricity bill, all these are having physical payment of cash and they are going to be recorded in books of accounts. So these are called as explicit costs. And implicit cost, if any cost is not having these two features, that is called as opportunity cost. Either you could not record in books of accounts and you could not made physical payment, and in that situation this is called as implicit cost. And next one, out of pocket cost versus book cost. So here there is some relationship existed between the above side heading and below side heading. That is, explicit costs are having both physical payment and entry in books of records. Both the features are must and shouldly have. And whereas in out of pocket cost, only physical payment of cost is existed, but you are not able to record in books of accounts. And whereas in book cost, you are going to write it in books of accounts, but you could not made physical payment with respect to these costs. Physical receipt or payment is not existed. For example, depreciation is there. You have purchased a machinery for 1 lakh rupees. This is life 5 years, and annual depreciation is 20%. And after 1 year, the value of machinery is 80,000. And for second year 20,000, and after 2 years the value of machinery is 60,000. In this way you are about to calculate the depreciation. Okay, so here this particular 20,000 rupees of depreciation per year is going to be recorded in books of accounts, but this amount is not going to be made physically to any other person. The value of the asset is going to be decreased because of wear and tear. That is called as depreciation. So this depreciation does not having the feature of physical payment, but having the feature of only books of records, entry in books of accounts. So that's why this is called as book cost. That's why it is called as book cost. And out of pocket cost, these costs are having the feature of physical payment, but these are not going to be recorded in books of accounts. For example, in today's for example, to get some sort of permissions, you are about to give some bribe to any other person. So here the physical payment of a payment is existed, but you should not record it in books of accounts that this particular amount is given as bribe for some other person. So you should not made an entry like this in the books of accounts. So that's why these kinds of costs are considered as out of pocket costs, because these are physically paid and not recorded in books of accounts. Replacement cost versus historical cost. Replacement cost means if you are about to replace your existing assets with new one, that is called as replacement cost. For example, you want to demolish the old building and construct a new building. This is called replacement cost. And you are going to replace your outdated machinery with the advanced technology machinery. That is called as replacement cost. And you are going to replace the old furniture with new one. So these all the things are called as replacement costs. And next one, historical costs. So the costs which are incurred in the long back, those are called as historical costs. Before 20 years, you have purchased a building, or before 50 years, you have purchased a land. So all these costs are very long back in nature. Those are called as historical costs. And next category, past costs versus future costs. Past costs are incurred in past, and future costs are to be incurred in future. In future, you want to replace the machinery. For example, you have purchased machinery right now. The machinery life is 10 years. After 10 years, you have to replace the machinery. Means within the next 10 years, you have to purchase a machinery. This is the cost relating to future. That's why it is called as future cost. And recently you have purchased a machinery, that is related to past. And recently you have purchased a furniture. So all these are past costs. Next one, special costs versus common costs. Special costs are those costs which you can easily identify. These particular costs are related to these particular product or department. Those are called as special costs. And common costs. Common costs are those costs which are incurred in common for on behalf of the all the departments or all the products. Those are called as common costs. For example, to manufacture a product, you need to incur some quantity of raw material. That raw material quantity is unique for each and every type of product. So the raw material cost is special cost. And for the sale of these particular products, finished products, you have to appoint a salesman. These salesmen or sales team or sales department are going to sell all the products manufactured by the organization. So here the sales department expenses or salaries or total costs incurred by the sales department are on behalf of the all products manufactured by the organization. So these are the sales department expenditure is considered as the common cost, because the sales department is going to sell all the products manufactured by the organization. So in this way, special costs and common costs are going to be existed. And next one, accounting costs versus economic costs. Accounting costs are those costs which are going to be recorded after incurring the expenditure. That is called as accounting costs. For example, you have purchased the raw material, and after purchase of raw material, you are going to note it down the amount of purchase, and like the same way you are going to note down the what is the amount of salaries after making the payment and transportation charges after making the payment. So all these things are going to be recorded after making the payment. Means when you have met with an expenditure, then you are going to record it. This is called as accounting costs. And economic costs are related to the future expectations. These are the costs which are about to be perceived by the economists. For example, in future, what will be the amount of raw material in the next after next 1 year, and what will be the labor charges after 1 year, and like this you are going to estimate the future cost. The economic cost concepts are the economic cost concept is mostly used in while placing the tenders. For example, some of the tenders are there, uh, they are going to be placed, they are going to take a long time for construction of this particular project. For example, construction of a dam, it takes approximately 15 to 20 years. For construction of a national highways, it takes 5 to 10 years. It takes 5 to 10 years, approximately 2 to 5 years minimum. As a minimum, 2 to 5 years is going to be considered. So during all this time, the costs are going to be not going to be remain constant. At the time of making tender, you may have some amount of cost, some amount of labor charge, uh, and these are going to be increased in year by year. So these are to be estimated and included in tender cost also. So while placing the tender, you are about to mention the cost of that particular project. And at that time, you have to consider these economic costs. So for this, you have to consider the inflation rates of past, and you are about to expect future inflation. And in this way, you have to estimate the future costs, and these are called as economic costs because these are going to be expected by the economists. And next one, urgent cost versus postponable costs. Urgent costs are those which are about to met urgently. So all of a sudden you have to meet this cost. For example, the raw material is going to be out of stock in soon. In this situation, you have to purchase the raw material. So since some days you have not placed the order for purchase of raw material because of increasing prices in the raw material, and you have been waiting for reduction in the raw material price, but it is not reduced so far. So in this but it is the time but it is the time which is about to get out of stock raw material. In this situation, you have to purchase the raw material at the prevailing price, whatever it may be the existing price. You have to purchase the raw material. Otherwise, in case of absence of raw material, you have to pay the all the remaining costs except purchase of raw material. So because of lack of raw material, your production is about to stop, and you have to pay labor charges and maintenance charges. Everything you have to incur. So like this, because of not manufacturing the products, you have to maintain these costs, and you will get loss as you are not manufacturing the product. Means as you are not manufacturing the products, you are not able to sell the products, and you will not get any amount of revenue, but you have to incur the cost of paying the salaries and paying the labor charges and maintenance charges. Everything you have to met. So that's why you have to take the decision that you have to purchase the raw material at any cost. So that's why it is considered as urgent cost in this situation. The situation is the out of stock of raw material. And next one, postponable cost. And some of the costs are there. These are not need not to be incurred immediately, and these can be incurred after a time period. So you have some time period to incur these costs. For example, uh, construction of a compound wall. So there is no urgent, or you need not to immediately construct the compound wall. So because it does not going to affect the production. So the construction of compound wall can be postponed to some time period. So in this way, postponable costs are there. And next one is escapable costs versus inescapable costs. Means here some of the costs you can completely skip, and some of the costs you cannot completely skip. Here the perfect example is variable expenses and fixed expenses. If you reduce the quantity of production, your variable expenses are going to be decreased. If you stop the production, you can completely skip the all variable costs, and you cannot skip fixed costs as you have reduced the production, or you have made the production quantity zero. So you cannot escape from incurring of fixed costs. So that's why it is called as inescapable costs. So with this, the cost concepts are completed. Thank you.
Like, share, and subscribe. Hit the bell icon for more updates.